So in this video, I'm going to talk about eBay. eBay is an online auction website. I'm sure everybody's heard of it. And what I do is I run my own discounted cash flow model to figure out the intrinsic value of a stock and then compare it to the actual stock price to see if it's a buy or a sell. And we also look at the financial ratios and compare them to its competitors. So let's get started with the model. So eBay has a market cap of $38.15 billion. And then we need a market price, and that's $54.38. And next we need the free cash flow. And free cash flow is cash flow from operations minus capital expenditures. And in order to value a business, you have to estimate the future free cash flows and then discount those numbers back to today's value. And that's exactly what I'm doing in this video. Now I'm pulling the net income, which is the profit and loss, and that's on the income statement. And then we're going to pull the revenue, which is just the sales for the company. That's also on the income statement. And the numbers look pretty good, although in 1 year they had a negative net income. Although they had positive free cash flow of $2.4 billion that year, so it must have been a non-cash item. Hopefully that doesn't affect the valuation too much. But let's get the capital structure of the company so we know what to discount the future cash flows by. So they pay $311 million of interest on their debt, and that's on the income statement. And we'll go to the balance sheet to see how much debt they have. Then we'll go to the liability section. And under current liabilities, it shows current debt of $1 billion. And then under non-current liabilities, it shows long-term debt of $6.7 billion. And interest payments are tax deductible, so let's get their effective tax rate. We'll go back to the income statement, and the income before tax is $2.2 billion, and the income tax is $415 million. So their effective tax rate is 19%, so their cost of debt is 3.25%. Let's figure out their cost of equity. We need the beta for that. That's the volatility of a stock. And the beta is 1.32, so the stock moves a little more than the market moves. We also need their current assets, and these are assets that can be liquidated into cash within 12 months, and they include cash, accounts receivables, and inventory, and it's $4.7 billion. Next, we need the current liabilities, and these are payables and debts, which are due within 1 year, and that's $4 billion. We also need their equity. That's the value of the company according to the balance sheet. That's total assets minus total liabilities, and their equity is $2.9 billion. We also need their EBIT, earnings before interest and taxes. On the income statement, they call that operating income, and that's $2.3 billion. So that's how much money the company makes on its operational business, but before they pay interest on their debt and before they pay their taxes. So in order to calculate the weighted average cost of capital, it's a blend of the cost of debt and the cost of equity. And the cost of debt is 3.25%, and the weight of debt is 73%. And the cost of equity is 12.46%, and the weight of equity is 27%. So the weighted average cost of capital is 5.74%, which is a combination of the 3.25% of debt and a 12.46% of equity. So we're going to take that 5.74% and discount the future estimated cash flows. So I estimated 4 years of future free cash flows. Then I estimated $24.4 billion for terminal value. The terminal value is all years past year 4. We discounted those numbers back to today's dollars. We get a value of the company of $29.4 billion. We divide that by 702 million shares, and we get an intrinsic stock price of $42. It's actually trading at $54, so it's trading at a 30% premium. So it's a sell according to the model. Let's see what Simply Wall Street values a company. And I think this is the first time that they value the company as a buy, and I'm valuing them as a sell. I think they're valuing them as a buy because of the future expectation of the company, where I'm just focused on the previous financial information. Let's see their historical stock price. So it's been up and down over the years, but it's really shot up. It's at an all-time high currently. Even during coronavirus, it's still doing really well. Let's take a look at their financial ratios. They have a PE of 21. That's a little on the higher side. I like to see around 15 or lower. The average in the market is 27, and the median in the market is 15. Their price to sales ratio is 3.5. That's also a little higher than what I like. The average in the market is 4.1, and the median in the market is 1.7. They have a high price to book, probably because they have a good amount of debt. And their price to book is 13.3. The average in the market is 4, and the median in the market is 2.3. They have a good current ratio at 1.2. The average in the market is 1.6, and the median is 1.2. Really high ROE, 62%. The median ROE in the market is 15%, so they're well above most companies. They're doing fine in interest coverage. They cover their interest expense 7.5 times. Interest coverage ratio is EBIT over interest expense. And they have 73% debt, which is definitely higher than most companies. And the only other company I did a video on that's in the same industry is Amazon. So this is eBay compared to Amazon. And if it's colored in orange, that means they did better in that particular category. So eBay has a much better PE. Amazon's PE is through the roof just because their stock price is so high. And their price to sales on eBay is a little better. And they also have a better price to book, but both companies don't have a good book. They're both doing fine in current ratio. ROE, eBay's much better ROE than Amazon. Amazon has little debt compared to eBay. And of course, Amazon is one of the biggest companies in the world, so it's obviously winning in market cap. So let me know what you think of eBay, what you think of the video. Leave a comment. Thanks for watching.